In today's video, we're going to go back to our conversation about variable versus fixed rates, but we're going to add one more option into the mix. That's a hybrid of both. Did you know that you could have both a fixed and a variable rate? The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, so welcome back. Today we're discussing fixed versus variable rates, and we're adding one more option to the mix, which is both. But before we get into the video, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky winner is gonna win $5,000 when we hit 25,000 subscribers. I sincerely hope it's you, but in order to win, you have to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. So let's get into it. Let's discuss fixed versus variable rates, and then we'll talk about the hybrid option, the option that not a lot of people actually know exists. So first and foremost, let's talk about why people choose variable over fixed rates or fixed rates over variable. And a lot of the time it has to do with risk. And quite simply, it's risk aversion that causes most people to choose fixed rate mortgages, because rarely is there a time where, statistically speaking, a fixed rate mortgage is going to outperform a variable rate mortgage. And that includes even times when interest rates are going to go up. What typically makes the biggest difference between a variable rate beating a fixed rate is the difference between the variable and the fixed rates at the time you get the mortgage. So in other words, if there's a really big spread between the two, usually variable rates perform better. And as that spread gets lower and lower and lower, then fixed rates tend to perform better. And very rarely are fixed rates and variable rates priced at very similar rates, which, by the way, is about the only time that fixed rates tend to perform better than variable rates. Now, that's not to say that there isn't going to be times where, even when there is a big spread between variable and fixed rates, that maybe a fixed rate won't perform better. But generally, if you got a big spread between the two, then a variable rate is typically going to outperform that fixed rate. But for most people, it isn't a question of what's the likelihood I'm going to save, but the comfort level of actually taking the risk of having a variable rate mortgage. And you have to think of it this way. When you're getting a fixed rate mortgage, you're pretty much paying for insurance against interest rates rising, right? Because you're paying a premium typically for a fixed rate mortgage up front by paying a higher interest rate. And by the way, you're going to pay a premium down the road if you go to pay out that mortgage in the form of a penalty, because penalties on fixed rate mortgages tend to be higher. And in general, they just typically cost more. So you pay more up front, you pay more at the end, and you also lose your flexibility, which means that you could end up paying more on consecutive mortgages in the event that you go and move to a different property or you make changes. A lot of bankers will tell you that mortgages are portable, so you don't ever have to worry about a penalty. But keep in mind that when you have a big penalty, it takes away your options, it takes away your flexibility, it often takes away your ability to leave, which means that if you are porting the mortgage to a new property, to a bigger property, and you need more money, they get to charge you pretty much whatever they want when it comes time to actually quote you a rate on the new money. Now, that's not to say that they always will, but it can happen, and we see it happen quite frequently. The other thing to keep in mind is with fixed rates, even if you're going to port them, different banks port mortgages in different ways. Sometimes they do blends and extends, which extends your time in that mortgage. Sometimes what they do is they create a whole nother mortgage. So they say your original $500,000 that you borrowed, Mr. Borrower, is going to be one mortgage, and then we're going to add the $200,000 more that you need, and you're going to have two separate mortgages. And if you don't get the renewal dates lined up on those two mortgages, it can basically make it so you almost always have a penalty and it's hard to leave. So there's a lot of things to keep in mind with that fixed rate mortgage, and keep in mind that you are paying a premium to have that ability to have that mortgage rate locked in. Now, how we typically help couples decide whether they belong in a fixed rate mortgage or a variable rate mortgage is we sit them down at the kitchen table or the office or wherever we're doing the mortgage. Maybe it's on a Zoom call, and we say to them, Mr. Borrower, Mrs. Borrower, would it keep you awake at night knowing that your interest rates could go up and therefore your interest costs could go up? And if you have an adjustable rate mortgage, your payments could go up. And if one of the two even has the most slight hesitation, then we start to have a further conversation about fixed rates versus variable rates, because the one thing that breaks up marriages most is finances, and we don't want to be the mortgage broker or the lender that breaks up marriages by putting a spouse into an uncomfortable position where they have a variable rate mortgage and where they're constantly worried and they're going to have anxiety. So that's the first thing. The second thing we talk about is, are you going to have anxiety? Are you going to be constantly calling and saying, should I lock in? Should I lock in? Should I lock in? And if that sounds like it might be you, then maybe a fixed rate mortgage is a better option. But you need to understand the difference in payments. You need to understand from a dollar perspective, not an interest rate perspective, because keep in mind that when people chase interest rate, they're usually stepping over dollars to save pennies. But from an actual dollars perspective, what's the dollar difference in payments every single month? How much more is that costing you every single year? And then is it worth it to you to pay that basically insurance premium in order to have that fixed rate mortgage? So that's the basics of it. Now, variable rate borrowers tend to be people who are a little bit more savvy investors. They want to have no risk of a payout penalty. They know that statistically there's only a 40% chance that they're going to have that mortgage till the end of the term. And therefore they know that they're probably going to have a penalty. So they want to avoid that. So they have a 3-month interest penalty with a variable over an interest rate differential with a fixed rate mortgage. Maybe they're purchasing an investment property, which what we recommend to our clients is that you always have variable rate mortgages on your investment properties. One, because it's an investment, you want to save money on the interest, but two is because you want to be able to get out of that property really quickly and really easily. And you want to be able to do it without giving a whole bunch of your equity back to the bank. So now that leads us to the point where this gets really interesting, because what if you're the type of person that, is 75% the type of person who would get a variable rate, but you don't want to take all the risk? Or maybe you are 25% the person that would take a variable rate, but you are 75% risk averse. So you want to mitigate your actual risk. And the good news is there's a really great way to do that. And that is with a hybrid mortgage product. Now, these are few and far between. Not every lender offers them. Well, our favorite bank, which if you go back and look at some of my previous videos, you can figure out who my favorite bank is. Well, they tend to offer one, and they have a great product for this. And what it is a hybrid mortgage, and you can split it into 3 different parts. You can split it into partially a line of credit, which is obviously a variable rate. You can split it into a variable rate mortgage, and you can split it into a fixed rate mortgage. So what you get to do is you get to adjust your risk profile based on how much variable and how much fixed you choose. So what you can do is you can say, okay, well, I don't want to be completely exposed to rising interest rates, so I'm going to go 50% fixed and 50% variable. Or you can say, well, I want to have a fixed portion because I want to mitigate the potential amount that my payments could go up, but I want to make sure that I have a lot of variable rate portion because I don't want to get exposed to a penalty. So I go 75% variable and 25% fixed. Or what you can do is you can pick any number between those two that you like. And basically what you're doing is by taking a portion fixed and a portion variable, it's basically like investing in a portion in bonds and a portion in stocks. You have the high risk portion and you have the low risk portion. And as a result, what you do is you reduce your overall risk because you've taken a portion in a fixed rate mortgage. And here's the great thing is you can take those 2 mortgages and you can say, okay, I'm going to use my prepayment privileges because I'm a savvy mortgage investor and a savvy mortgage borrower. And I am going to pay down one quicker than the other based on what the interest rates are at the time. So maybe I've got an extra $5,000 that I want to put on my mortgage. And I'm going to take that $5,000 and I'm going to apply it to the fixed rate mortgage because that's the one that has the higher interest rate. Or maybe interest rates go up and your variable rate creeps above what your fixed rate mortgage is. And you say, well, I'm going to apply the $5,000 to that because it's got a higher interest rate. Or maybe you say, I just have $5,000 that I want to invest, and you apply it to either portion and then you redraw it out in the form of a line of credit, which becomes tax deductible. Check out our video on the Smith maneuver for that. And you take it and you pull it out. The interest is now tax deductible because you use that money to purchase investments. So there's a lot of things you can do with this sort of hybrid mortgage, lots of flexibility. And it's a really great option for those who aren't 100% sure that want a variable rate and they want to basically reduce their overall risk of interest rate increases, especially as we come up on a period of time where it looks like interest rates are going to start to go up. If you like this strategy and you want some expert advice on this strategy, then you can obviously apply with us at Mortgage 360, or you can go to our Rate Secrets course. And by the way, if you are looking for a mortgage and you're thinking about this strategy, you probably need to take our Rate Secrets course because it's got all the information you need to make sure that you don't get burnt when you're out shopping for this type of mortgage. You can find the Rate Secrets course at ratesecrets.ca. And at the end of the day, if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next video.